Hello everybody and welcome to our next video discussing various practice journal entries. This is number 3 in the series, and in this video we're going to be still talking about some basic journal entries, but we're starting to get closer to our actual adjusting journal entries. This particular video goes through the prepayments, basically setting the payment up, so buying something in advance that we're eventually going to use, and then when we use it, that's where the adjusting entry is going to be. So we're going to talk about this. Now, for the next couple of videos, we're still going to go through these basic rules. Just as a reminder, we will drop them off eventually, but this just gives you enough repetition to get you used to the rules so they get ingrained in your mind. So, again, debits are always going to be found on the left side. Debits always come first, and credits are always going to be found on the right side. And no matter how many credits you have or how many debits you have, the credits always come afterwards. Now remember, as far as the balance rule, you can have a different quantity of debit versus credit entries. You could have 2 debits and 1 credit or vice versa, but the dollar amount is what really matters. The total dollars of all the debits must equal the total dollars of all credits. And just another reminder on the normal balances, we have this mnemonic device. The DEAD, D-E-A-D, debit accounts include expenses, assets, and dividends. And the next one would be clerk or Clark, C-L-R-C. Your credit accounts include liabilities, revenues, and common stock. Now keep in mind when we say normal balance, that's what you do to increase an account. If you want to decrease the account, you do the exact opposite. So the steps for the journal entry: step 1, you have to identify what accounts and what amounts are going to be involved. Step 2, identify whether you're increasing or decreasing those accounts. And step 3, identify what that really means as far as debits or credits. How do you increase or decrease that account? And to do that, you have to know the normal balance rules. And step 4, just as a final check, ensure that the debits and credits in each journal entry balance out dollar-wise. And that's the key thing. It has to be the dollars. So now we're starting to get into the adjusting entries. They'll come up in the next video. But again, this one sets the stage. But I do have some important notes about this, about our lead into the adjusting entries. We're going to talk about 2 different groups of adjusting entries in the next video: the prepaids or deferrals, and then the accruals. For the deferrals themselves, these are things you pay for in advance or you receive cash for in advance, depending on which side of the transaction you're on, and then later on you use it up or you earn it. So these prepaids or deferrals, there are 2 different methods that are available, and we're going to talk about, just briefly in the next slide, we're going to talk about these 2 methods, but that will lead into the next couple of videos dealing with how you're actually going to record those. So for example, like the supplies, the prepaid insurance, inventory, these are things you pay for in advance. So a cash transaction happens now. It's just considered a regular transaction. The adjusting entry will happen later, but the question is the timing and how you report it first, and then how you can report it when you do the adjusting entry. The thing to note about all of these types of accounts is that they will eventually impact both a balance sheet account, which would be either an asset or a liability, and they will impact an income statement account, either a revenue or an expense. The question is all about the timing of that. For example, when you prepay for something, you're spending cash, and that prepaid item is going to be considered an asset up front. The amount you have not yet used is going to be an asset. The amount you use when you use it will be considered an expense. Now there's also the unearned revenue, which is a deferred revenue. That means you've received cash in advance, but you haven't earned it as revenue yet. So the part you have not yet earned, we'll find out next week or next video, is going to be considered a liability. The part you have earned, when you earn it, is going to be a revenue. So that's my point. They will impact both of these accounts. The unearned portion, or the portion of the prepayment we haven't used up, is going to be in the balance sheet. The portion we've used or earned goes in the income statement account. Again, the question is about timing. When does it move to the revenue or expense account? So method one, the standard method, the most common method of all, is that when you first receive cash for something, if it's a prepayment of something you're going to earn later on, or when you first pay cash for something that you're going to use up later, the method one says let's put it in the balance sheet account first, either the asset or liability, and then at the end of every period, we're going to take a look at how much of this revenue have we really earned, or how much of this expense have we really used up. And that's when you move it over to revenue or expense. So you start off on the balance sheet, move things over to the income statement. Method two is the alternative method, and that basically says as soon as the cash changes hands, let's report it all in the income statement accounts, either revenue or expense, which in a way kind of assumes that we are going to use up all of that asset and use it all up as an expense, or that we're going to earn all of that revenue right in that period. Now, at the end of the period, if that assumption doesn't hold true, then you basically have to move the portion that you have not earned, or move the portion of the expense that you have really not incurred yet, back to the balance sheet account for temporary storage. And then later on, you'll determine next period how much of it have you used up then. So this video, number 3, and number 4, where we discuss the adjusting entries themselves, that basically sets up the first method. And then we'll come back in video number 5, and we're going to see the entirety of the alternative method. So that's just the point I want to make here. A lot of textbooks start off with the standard method, but then a lot of times they'll maybe have an appendix to discussing the alternative method. It's important to understand that, again, the whole point is by the end of the period, we want to make sure that every account is up to date. The amount we have not used up is in the asset. The amount we have used up is in the expense. What you do up front really doesn't matter as long as you follow through at the end of the period and adjust everything appropriately. So that's the point I want to make. We'll see this more over the next 3 videos. So transaction number 1, we are purchasing something. Again, we're prepaying for it before we've used it completely. So things like equipment. We've purchased $100,000 worth of equipment for cash. This will be used over the next 10 years, and it will be depreciating at $10,000 per year for 10 years. So the transaction here is just simply to record the purchase of the equipment. Now, for the next couple of videos, I'm going to keep the accounting equation discussion here as well, and then go to the journal entry. This is just to build up your comfort with doing a journal entry. You don't normally need to use the accounting equation before you do the journal entry, but sometimes it's helpful to see, hey, everything's still in balance. So we'll keep this for the next couple of videos, and then we'll drop off and start talking just about journal entries. So for the accounting equation here, we had 2 assets that were impacted. Cash decreased by $100,000. The equipment asset increased by $100,000. So we're still in balance. This nets to 0, and of course nothing is happening on the other side. The journal entry here would be to debit equipment, because that's an asset. It has a normal debit balance. So we would debit the equipment for $100,000 to increase it. Cash is also an asset. It has a normal debit balance, but we want to decrease it, so we're going to credit it. Debit equipment, credit cash, the dollar amounts tie out. Transaction number 2, very similar. We are purchasing something in advance. We're purchasing supplies in advance. Now, a lot of times when you see this problem, they'll tell you how much did you purchase, what the beginning balance was, and either what you used up or what the ending balance was. For our purposes here, for this initial entry, we just want to know what did we purchase. And we just purchased $3,000. We'll deal with the rest of this later in the adjusting entry discussions, but for right now, we just purchased $3,000 worth of supplies. Now, the other thing I want to mention is it was on account. We didn't pay cash for it. So we're increasing the supplies asset for $3,000 and increasing the liabilities, the accounts payable, for $3,000 as well. So two accounts are being increased, and that can happen. Supplies are an asset. They have a normal debit balance, so we want to debit it to increase it. Accounts payables are liabilities. They have normal credit balances, so we credit this to increase it. So let's take a look at transaction number 3. Now, the one thing I want to mention here as a reminder, as you're going through these practice journal entries, it might be handy to pause the video after we read through the problem, after I talk about it, but before we look at the solution. Sometimes it's handy to do that. You can either jot it down on paper, put it in Excel, just think about it in your mind, just to quiz yourself before we get to the solution to make sure you fully understand it. So for transaction number 3, we're talking about a prepayment. In this case, they're prepaying $1,200 for 1 year's worth of insurance, so $100 a piece per month, on June 1st, 20, that will expire on June 1st of 2021. We want to record the prepayment of this insurance. So we're decreasing cash since we're spending cash right off the bat. So we're negative $1,200 cash. We're increasing another asset, the prepaid insurance. Now, if you want to visualize this, if you need a tangible asset to really visualize this, you could pretend that when you're buying the insurance, that the insurance company gives you a booklet of coupons, 12 coupons, one per month, and as the month passes, you rip out one of the coupons and you use it up. If you want to do that just for visualization, and then you'll realize that, hey, we bought this asset, we bought this book of coupons, and then we're going to use it up over time as the month passes. That's one way I like to visualize it for people. So our assets net out to zero, one increased, one decreased. On June 1st, we are going to increase the prepaid insurance asset. It's a normal asset. It has a debit balance, so we increase it with the debit. The cash asset that we're decreasing has the opposite of the normal balance, the credit. So we're crediting cash to decrease it. Now, by the way, one of the things I want to mention here, I know we haven't talked about this a whole lot with the normal balance rules for assets and for cash. One of the things that first confused me in my very first accounting course was why cash is increased with debits and decreased with credits. Because when you look at your checking account register, for example, your bank account, you see the deposits are credits and the withdrawals are debits. Now, the reason for that is that cash account you're looking at is actually the bank's liability to you. When you increase your cash account, when you deposit money, it shows up on that bank register as a credit because that bank's liability to you is getting credited. It's increasing. So that's the thing to consider there. I just wanted to throw that in here. I think we've seen plenty of cash entries up to this point, but I wanted to throw that just to reinforce that. So we're crediting cash to decrease it in our accounting register. Let's go through one more prepayment. The company prepaid 1 year's worth of rent that would normally cost $1,000 per month. So it's 1 year, $1,000 per month. That's going to be $12,000. So we're going to record the full prepayment of the 1 year's rent. Very similar to the last prepaid insurance, we have one asset decreasing with cash and one asset increasing, the prepaid rent. Again, you can visualize it the same way. Think of the landlord giving you a booklet of coupons, whatever works for you. But the entry is going to be basically the same. We're debiting the prepaid asset, the prepaid rent in this case, to increase it. And we're crediting the cash because we're decreasing that. Now, all of these assets that we've been increasing, the point is later on, we're going to have to show that, hey, we've really used some of this up. At the end of the next period, we've used something up, and it's no longer an asset. Instead, it would be an expense. So this first entry is the initial entry to record the payment, but later there will be an entry to move it to expense. Now remember the two methods I talked about, I said under one method you can load it up as an asset first because it really is technically an asset on day one. It's unused. And then later on when it's used, it would be moved over to an expense. Method two that we'll talk about in a couple of videos would say, let's just move it all to expense first, but then any portion at the end of the period that we didn't actually use, we'll move it back and store it here as a prepaid rent asset. So just keep that in mind there. Now let's move over to the other side of the transaction where we are now receiving money in advance. It's still technically a prepayment. We're just on the other side of the transaction. In other words, it's a prepayment to us, or you might think of it as a pre-receipt. It's a prepayment to us from our customer or our tenant, and it's still a deferral. We're deferring the recognition of revenue because, yes, we've collected it, but we haven't actually earned it yet. So the company received rent in advance from their tenant in the amount of $6,000 covering 6 months. So again, it's $1,000 per month. Record the prepayment. So in this case, we have an increase to cash. We are receiving more cash, but we also have an increase to a liability known as unearned revenue. Now I know when you see the word revenue there, it sounds like, hey, this is a revenue type account, but it's unearned revenue, which means it's a liability. It's a liability to our customer because we owe them something down the road. They've given us money. We owe them something in return that we have not yet given them, whether that be the service or maybe eventually we have to pay them the money back if we can't provide the service. So we're increasing an asset, cash. We're increasing a liability, unearned revenue. Now this was on 10/1, so we are increasing cash with its normal debit balance for that asset. We debit cash for $6,000. Unearned revenue is indeed a liability, and it has a normal credit balance, so we credit unearned revenue to increase that. Let's go to transaction number 6. In this case, it's still the same thing. It's still an unearned revenue. We've received $5,000 for services that are going to be provided in the next period. So in this case, we are still receiving cash, so we have to increase cash, and it's still going to be called some sort of unearned revenue. It's still a liability. We owe the customer something that we have to give them eventually. So really the transaction's the same here. We are debiting cash to increase it for $5,000, crediting unearned revenue for $5,000 to increase that. Now again, this is the initial entry. Down the road, we will have an adjusting entry as we earn some of that. Transaction 7, very similar, just another example of an unearned revenue. I'm just trying to show you different types of verbiage that you may see in the problems that you're dealing with. Here the company received a down payment of $2,000 for a product they're scheduled to deliver in the next period. So in this case, it's going to still be an increase to cash and an increase to unearned revenue, now for $2,000. Still a debit to cash to increase it, and a credit to unearned revenue to increase that liability. So it's the same transaction, just the dollar amount's different, and the verbiage for the problem is a little bit different as well. So let's move forward to a note about what we're dealing with. And as I reiterated up front, these entries that we just now discussed set up future adjusting entries, but they themselves were not adjusting entries. A very big clue to know that you're not really in an adjusting entry is that if you have cash in the entry, it's not an adjusting entry. If it's an actual cash payment or an actual cash receipt that you're now dealing with, that's not an adjusting entry, but there will be a later adjusting entry or possibly an earlier adjusting entry related to this cash payment. That'll make a little bit more sense when we get to the next video. These particular ones were called prepayments, and that's when the cash entry happens first, and the adjusting entry happens later, they're sometimes referred to as deferrals, deferral of revenue or deferral of expense. And again, they can happen either with the company paying cash in advance or receiving cash in advance. The related adjusting entries to actually recognize some of this as revenue or expense will come up in the next video. So just another reminder, the whole purpose of this series of videos is to give you a chance to practice these journal entries as you're building up your expertise in accounting. Once you get these hammered down and locked in your mind and you fully understand how to quickly do an adjusting entry, it's going to make the rest of your accounting experience much smoother. So there will be more examples. Every video will continue to get progressively more complex. We'll throw in new types of journal entries, new examples, new verbiage, just to quiz you and to prepare you for what's to come throughout the rest of the course. So I thank you for your time today, and I look forward to talking to you in the next videos.